What we're going to be going over here is available for sale trading securities for holding investment securities less than 20% ownership interest in a corporation. And where you have security holdings of less than 20% in another corporation, this is where you use the fair value method here to record those security holdings that you have here. And for example here, Corporation A acquired 10% of the 200,000 shares of common stock here of Corporation B. So after acquiring the 10% of those shares here, Corporation A now owns a 10% interest here in Corporation B. And the cost when they purchased those shares here was $28 per share, and Corporation B has paid a cash dividend of $150,000 here for the year. Also, Corporation B reports net income here of $244,000 for the year. And the other thing that we have to note here, the market price of the common stock here of Corporation B was $30 per share here on 12/31/X1 at the end of the year here. Okay, so let's go up here and let's start with these available for sale securities, again using this fair value method here. And when you're using a fair value method here and for recording these securities here, you're going to have to set up a securities account here called available for sale holding securities here, and along with that you're going to have to come up with this fair value adjustment account. It's going to be a valuation account, and in conjunction with the fair value adjustment account you're going to have some unrealized holding gains and losses as part of equity here. And for example, we're going to have to deal with the cost of these securities, setting them up here at their cost, and then also we're going to have some dividends that we're going to have to record here from Corporation B, or the investment here in Corporation B, the percent of dividends we get, and also we have some net income here to deal with. But before we get into the net income here, we have to make a point. You do not, when you have a less than 20% interest in the corporation here, your investment in that corporation, you do not share in any net income here. So the net income here of investee Corporation B, the net income that was $244,000 for the year, it wouldn't be involved here when you're setting up your available for sale securities here, and it wouldn't be part of any recognized in our example here. So we wouldn't be recognizing any net income, and that would be the same for our trading securities as well. So starting with our available for sales securities here, you set up your investment account here, and what would you put in? And that would be at the cost here. Well, there was 200,000 shares here for Corporation B has outstanding. Corp A has now invested or purchased 10% of those shares here at $28 per share. That's their cost. That was the cost of those shares here. So that equates here to $560,000. So debit or increase your available for sale holding here by $560,000 again on your balance sheet. And then in your cash account you would reduce it by $560,000 here, what you paid for those securities. And then just looking at our let's just move over to our dividends here. So Corp B here has cash dividends that they paid here for the year of $150,000. Corp A owns 10% interest, so they're going to get 10% of those dividends. So they credit your dividends revenue here on your income statement here for $15,000. And then your cash account, moving over your cash here, you would have received $15,000 in cash for the cash dividends received here from Corporation B. Now, we have to deal with this fair value adjustment here. So when you're using the available for sales here, and we'll see it in trading securities as well here, you have to set up a fair value adjustment. And what you do here is you adjust the value of your available for sale securities at the end of each reporting period. And this fair value adjustment here directly adjusts the available for sale. So any increases in your fair value adjustment will increase your available for sales account here, and any decreases will decrease it here. So let's just look at this fair value adjustment for a minute here. So again, it's just a valuation account. Rather than recording everything, any changes directly in your available for sale account here, you record your changes here in your adjustment account. So again, that's a valuation account here, and you make your adjustments at the end of each period and end of each reporting period. So what we're looking at here in this case, the market price of those shares of common stock here are $30 per share here at the end of the period at 12/31/X1, and then what we paid for them, our cost here was $28 per share times the number of shares that we hold. So we had 10% of the 200,000 shares here of Corp B, so there's 20,000 shares, so that equates to $40,000. So our available for sale securities here increased at the end of the period here by $40,000. So you debit or you increase your fair value adjustment here by $40,000. Again, 12/31/X1, and then any adjustments that you make to your fair value adjustment account here, those go into an unrealized holding gain or loss account here as part of equity here on the balance sheet here. So we had that debit here to our fair value adjustment increased for the value of those securities for the period by $40,000. So our credit goes to the unrealized holding gain or loss as part of equity here for $40,000. So again, this is what you want to key in on here. When you're dealing with these available for sale securities here, this fair value method, you have to set up your adjustment account here, and any adjustment here has to go into, in this case, unrealized holding gain or loss on equity. We had a gain in this case, so we increased our unrealized holding gain in our equity account here by $40,000. Now, again, looking at this unrealized holding gain or loss equity account, that's reported as other comprehensive income here as a separate component of shareholders' equity. We're not going to get into it, but that's where it goes. It goes as a separate, as other comprehensive income in shareholders' equity. Okay, so we've taken care of our available for sale securities here using the fair value method. Now, and again, we have to note here, we had that net income here of Corp B has net income here for the year of $244,000, but since we have a less than a 20% ownership here, there's no share in those that net income here of Corporation B. Corp A doesn't get any of that net income, so that doesn't get recorded here, and it doesn't become part of Corp A's recording here for these available for sale securities. Okay, now let's move down here and look at trading securities, again using the fair value method here. Now, we don't have to go through all this, but this is the key here. It's the same as available for sale securities here, except any unrealized holding gain or loss goes to the income here on our income statement. It's going to go to the income statement. Okay, so just looking at our accounts here for our trading, what you're going to have to do is set up these accounts here. Just title them here. In this case, trading securities for this holding less than 20% here. So again, just at our cost. We don't have to go through all of that here. Same as we did for the available for sales. They got a 10% interest here in the 200,000 shares, and again at the cost here of $28 per share. So debit that here for the same amount, $560,000 cash. They had to pay out $560,000, and same for the dividends here. Same as the available for sale here. You just get your share of the dividends here. The total dividend paid here by Corp B was $150,000 for the year. Corp A gets their 10% share here, so they credit that here for $15,000, and that's on the income. Dividend revenue here on the income statement, and then the cash, you would have debited debit your cash for the cash receipts here on those cash dividends paid for $15,000. Now we come down for the fair value adjustment. It's the same as our available for sales here, the fair value adjustment here, but what is different here is the unrealized holding gain or loss. In this case, it's going to the income statement. It's going to go directly to the income statement. For the available for sale, any unrealized holding gain or loss went into an equity account on the balance sheet. So for our fair value adjustment, same as we had for available for sales here. And again, that's done at the end of the period. We had the market price here per share at $30, cost of those shares at 28, so the difference times the percentage or the shares that we're holding here, 20,000 shares, that was simply the 200,000 times the 10% here. That gives us that $40,000 increase here in our trading securities for the period here. So fair value adjustment, same as before, $40,000, debit that here for $40,000, which increases our trading securities here. So if you're looking at that. You started out with $560,000 here in your securities account. You increased it by $40,000, so you got $600,000 dollars worth of your trading securities, and that's what we would have had same with available for sale. But the only difference is any fair value adjustments that you're making here to your trading securities here. In this case, we have that increase here, $40,000. That would go to an unrealized holding gain or loss, same as our available for sales, except that it goes to the income statement, gets reported part of incomes here on our income statement. With the available for sale, this holding gain or loss here went to the balance sheet, part of equity. But when you're dealing with your trading securities, the only difference here is your unrealized holding gain or loss goes to income. So we'd have credited that here for $40,000 here. And again, that would have been included in our net income for the current period. Whereas available for sale, that was reported as other comprehensive income, part of shareholders' equity. But when you're dealing with your trading securities, that the only real difference here is this your unrealized holding gain or loss that goes to net income for the current period. Again, you do not share, because you have a less than a 20% ownership in the company here, you do not share in any net income here of the investee corporation B. Okay, so we've gone through both the cases here for available for sale and our trading securities. And again, this is using that fair value method here. And this is where you use it when you have a less than a 20% ownership in the the securities that you're purchased here from another company. So everything, just remember here, you set up your costs here. In this case, whatever it was, trading securities here are available for sale. You record them at your cost, and then you make your adjustments separate from that here in a fair value adjustment account, and that's done at the end of each period here. And you have to look at your market price here, what fair value that is at the end of the period, and compare it to your cost times the holding interest you have in the number of shares you have in this case, and then you get your fair value adjustment. So if we had a negative change here, or our market price was less than our cost, then our fair value adjustment would have been, we would have to credit that or reduce that here, which would reduce our trading securities directly here. So had we had a negative, or we had to adjust made our fair value adjustment credit here, or reduced our fair value on those securities, then it would have reduced reduced whatever we have in our trading securities. So this is a valuation account, and we have to keep track of our securities here, either trading or available for sale. We have to keep track of them based on their fair value, and any changes to our adjustments get either unrealized holding gain or loss. Either trading or available for sale, they went into the equity. Trading securities, they go into the income statement on our income statement. Okay, so that'll take care of our using this fair value method here, looking at our trading securities versus our available for sale securities.